Hi, I'm Pattu from freefincal. Today let's talk about the second index fund by Nippon India, the Nippon India Nifty Midcap 150 Index Fund. Yesterday we talked about the Value 20 Index Fund, Nifty 50 Value 20 Index Fund, and this is the Midcap 150 Index Fund. Both of them are being launched in the same time. At the same time, the NFO period is between February 4th and February 12th for both. And the Nifty Midcap 150 is the middle segment of the top 500 stocks listed as per free float market capitalization on the NSE. The top 100 is defined as the large cap. In this, the top 50 is the Nifty 50. The bottom 50 in the top 100 is called the Nifty Next 50. Then you have the middle 150 stocks, which is called the mid cap segment, and the bottom 250 stocks form the small cap segment. So this Nippon India mid cap index fund will be the second index fund that's tracking the mid cap index, the first being the Motilal Oswal one. And there are several questions that investors tend to ask when they see something like a mid cap. And the first thing they should understand is that the Nifty Next 50 is not a large cap index. I have talked about this several times. In terms of risk and reward, it is more like a mid cap index. This is because of something known as the impact cost in the market. That is, if you try and sell a large quantity of a stock, there will be a difference between the bid price and the sell price in the market. This is because of a natural market supply demand imbalance, and this is not some expense ratio or demat account charges or brokerage charges or anything like that. This is a very natural gap. The problem is, for some stocks, if you try to sell large quantities, the bid price sell price difference will be very small, and for some stocks it will be very large. So which means that if a fund manager tries to sell a large quantity of certain stocks, then because of this impact cost, that is because of the difference between bid price and sell price, they will lose some money or gain some money. And if you look at the impact cost for the top 100 stocks in the Nifty in the NSE, only the top 50 or 60 stocks will have low impact cost. The bottom 40 stocks will have quite a large impact cost, and because of that, the Nifty Next 50 is not a large cap index, it is more a mid cap index. And so many people tend to ask, shall I buy? I already have Nifty 50, I already have Nifty Next 50. Shall I buy the Nifty Midcap 150 because of market coverage? We will see that there is practically no difference between the Nifty Next 50 index and the Nifty Midcap 150 index, and they are not going to get any additional benefit in adding the Midcap 150 index. And another thing people say is that they say that active midcap fund managers will easily beat the midcap index. This is not true. Only 6 funds have consistently outperformed the Nifty Midcap 150 index, and only again 5-6 funds have managed to beat the Nifty Next 50 index. So that is also a misconception that people should avoid. I have links for all this. I have shown how only 6 midcap mutual funds have bet the Midcap 150, and only 4 funds have outperformed the Nifty Next 50, and so on. Even the small cap funds are not able to beat the small cap active funds are not able to beat the Nifty Next 50 consistently. So you're not going to get any great additional benefit. What is going to happen if you invest in the midcap 150 index is that your expense ratio will become higher. It is very difficult to track 150 stocks, especially in the midcap segment, so your tracking error will be more. And I had just published another video on the on few funds that have outperformed their index. The Motilal Oswal Nifty Midcap 150 index has got more return than the index itself. That's because of the high tracking error. So these are all the factors that people should keep in mind. And now if you look at the data, this is the since inception growth of the Nifty Midcap 150 index, which is in red, and the blue is the Nifty Next 50 total returns index. Both of them are total returns index. You can see there's practically no difference. Both of them are the red line and the blue line are basically on top of each other. There are some regions where you can see in this bull run the mid caps have done well, but there are some regions where they have underperformed and so on. And as you can expect, if you look at the 5-year rolling returns, the blue is the Nifty Next 50, the yellow is the Nifty Midcap, There's practically no difference between them. And in fact, in some regions, the mid cap has actually underperformed the Nifty Next 50. Again, this is over 7 years, is not much of a difference, and the underperformance only is higher for the mid cap. And over 10 years also, there's really not much of a difference. So you're not going to get anything additional, you're not going to get anything extra, you're not going to get a coverage of 150 stocks by adding Nifty mid cap. Just stick to your Nifty Next 50 index fund. That is all you need. I have also talked about how you can combine Nifty 50 and Nifty Next 50 in several ways to create different kind of portfolios. You can have a predominant large cap portfolio. You can have a balance of large cap and mid cap portfolio just by combining Nifty and Nifty Next 50. So that's about it. There's nothing special in this NFO. Please avoid it.